Welcome to module number 5, where we are going to explore in this module the accounting for joint ventures. In the previous module, we explored the accounting for joint operations. So in this module, we will explore the accounting for the other type of the joint arrangement, which is joint ventures. Accounting for joint ventures mainly focus on the equity method. So in this module, we will explore how to apply the equity method for accounting for joint ventures. When an entity has joint control over an arrangement and has rights to the net assets. So look at the word, it's net assets. It's not the right of the assets or right of the liabilities. They have the right to the net assets. So the equity method here is applied for accounting. So in very short and in very brief, this equity method involves recognizing the investment initially at cost, and then subsequently each period will adjust this cost for the investment for the investor share of the joint ventures post-acquisition changes in the net assets, whether they are profit or loss. So what are the steps of the equity method of accounting? As we explained before, that we need initially to recognize the investment at cost, including any direct expenses of the acquisition. So if at your exam or in the real life, you had investment in joint venture and you spend some initial direct cost as a part of the acquisition of this joint venture, such as legal cost, for example, or acquisition cost, whatever the type of this acquisition cost. So in this case, all of these initial direct expenses that are related to the acquisition will be capitalized as part of the value of the investment. So this is in the first step, which is initial recognition. Then what will happen next? The accounting after initial recognition is called subsequent accounting or subsequent measurement. So subsequently, we have to adjust the investment for the investor's share of the joint venture's profit or loss, as well as any changes in other comprehensive income, i.e., meaning that we are adjusting for the share of the net assets of the joint venture. So if the joint venture achieved increase in the net assets, so we are going to add the percentage of the ownership of this increase in the net assets as increase to the investment value. So for example, if we have a profit this year, so in this case, we are going to calculate the percentage of the profit and then add it to the investment value of the joint venture. And if there is a loss, so we are going to consider the percentage of ownership of this loss and then deduct it from the investment value. So the investment value will go up and down based on the changes in the net assets of the joint venture. The step number 3 is related to the dividends received. So as an investor in a joint venture, we have to recognize the dividends that we received from the joint venture as a reduction in the carrying amount of the investment. So the carrying amount of the investment will be reduced by the dividends that we received. Why? Because we initially in step number 2, we added the percentage of the profit to the carrying value of the investment. So if you'd like to understand this, we are adjusting the carrying value of the investment up by the percentage of the profit. And once we receive the dividends, so these dividends will be reducing the value of the investment. So the carrying value of the investment will go up and will go down, will go up by the percentage of the profit. And once we receive the dividends, this will reduce the value of the investment because we received part of our profit cash in this case. So for example, a company acquires 30% stake in a joint venture for $300,000. So the initial recognition involved recording the investment at $300,000 in this case. Subsequently, what will happen? If the joint venture reports a profit of $50,000, so the investor adjusted the investment to reflect 30% of that profit, because this profit will be considered as a change in the net assets. So we are going to consider 30% of this profit, which is $15,000 in this case, and we are going to add it to the value of the investment. So the value of the investment will be increasing by the percentage of the profit. So let's review. Initial recognition of the investment in a joint venture involves determining the cost of the investment, including any direct attributable transaction cost. So for example, if a company incurs legal fees and other costs directly related to acquiring a joint venture interest, these costs are included as part of the initial cost of the investment. Then subsequently, after the initial recognition, the investment is measured at its carrying amount, adjusted for the investor's share of the joint venture performance. So if the joint venture report a loss, the investor reduces the investment carrying amount by its share of the loss. And the most important part here that you have to pay attention to the impairment. If there are indicators of the impairment, such as decline in the value of the joint venture, the investor assesses the recoverable amount and recognizes the impairment losses if necessary. So, for example, if a joint venture faces economic challenges that significantly impact its value, the investor assesses the recoverable amount and recognizes the impairment if the carrying amount exceeds the recoverable amount. First things first, that there are some disclosure requirements that we have to adhere to. Entities must adhere to specific disclosure requirements regarding the joint venture. And also, we have to consistently applying the same equity method and accounting policies from one period to another, because this will be essential for accurate financial reporting. In the next module, we are going to cover the disclosure requirements under IFRS number 11. Stay tuned and join me in the next module.